Hi, good afternoon. We will now start the webinar, so thank you for your record interest. And as I mentioned, today's webinar will be called Navigating the Risks in Rising Rates. So the recent market corrections following from the US wages number and fears of interest rate rises has certainly made for some interesting activity over the first couple of weeks of the year. To make sense of this and to sort of talk through his analysis and to hopefully present some opportunities to you and to navigate the risks, David Bassanese will be joining us. Before David starts, I do need to remind you that anything that we talk about today is general in nature and does not take into account any personal circumstances. Before making any decisions, you should talk to a financial professional. There will be a recording of this webinar and handouts on any information that we discuss will be sent to you. If at any time throughout the webinar you have a question, you would like to make a comment for David to answer, please do so the widget, which is, or the panel on the right-hand side. A recording of the session will be sent to all attendees after the webinar. And just before we start, I will just take a little pulse check and sort of see how everyone is feeling about the markets themselves. So, do you think that the recent market pullback is a correction or the start of a bear market? So it's obviously been a hot topic of conversation here at BetaShares, but it's always interesting to see how you are feeling. And there is a very strong feeling in the webinar that this is the start of a correction. So and a few unsure, but yeah, this is very interesting. Okay, great. Excellent. And just one more is, and this is a topic very close to David's heart because he always is asked a prediction on interest rates. So do you think they'll stay the same or do you think that they will increase in 6 months? This is for our own local market. Okay. Great, so a little bit more split there, but the majority of people thinking that they are going to stay the same for the next. There we go. So, yeah, so 66% thinking that they're going to stay the same. And for the bear market, just giving you an idea on how everyone's thinking about that. It's quite interesting. 74% thinking that there's going to be, that it's a correction. So, yeah, quite interesting. So, without further ado, David Bassanese, our Chief Economist.
Thanks very much, Sarah. Thank you, everybody, for tuning in in what is a very interesting time in the markets, of course, with the big correction in the US reverberating across the globe. So I'll be talking a bit about that today and sharing with you my views on, correction versus bear market debate and interest rate debate. I'll break it up into these three elements: the international outlook, the Australian outlook, and then some favoured investment ideas. And try to keep to a similar type of structure for these quarterly presentations, just to keep everything organised. So with that, so let's get into it. The first part, the international outlook. The first chart, as you can see, basically the single best summary indicator of the global economy is what's called the global composite PMI. And it's at about 54.6 in January, so it's still quite decent. Consistent with continued solid growth in global economy, running around about 3.75% or so, possibly 4%. And, the big story of last year has been, yes, the US economy has been strong for a while, but we've had a nice pickup in growth in Europe and Japan, and emerging markets have been looking good. And so the outlook there is still, based on all the economic indicators, still pretty good. So that is a very reassuring backdrop for the markets. But nonetheless, obviously, risks as to whether that will lead to inflation or higher interest rates, which we'll talk about. Now, so just digging into that a little bit deeper. So what's been driving that upturn? If you look at the components there, it's actually been a nice upturn in business investment has been the major change over the past year. And again, across the board, US, Japan, and Europe, all looking good. And again, one of the themes that may emerge over the coming year is that labour market tightness. As we'll get into, labour markets are getting tighter in these economies as the employment growth has been strong. Businesses are now starting to invest again to make up for the fact that it's harder to find workers. Now, another response might be higher wages, which would be a less positive, or I guess not for the workers, but obviously for the markets if inflation picks up. But a potentially good news story here is that business investment is one of the responses to labour market tightness, which will give another leg to the global growth story. Just on inflation, as you can see, the global situation is still pretty benign. So core inflation across the world still running at pretty low levels, only around about 1% or so. Headline inflation has ticked up, but that's usually more of a volatile measure and driven by changes in oil prices and whatnot. If you look at producer prices on that chart, they have ticked up. That has been noted, but again, it's at this stage it's mainly an oil price effect, and if oil prices kind of level out at these levels, that effect tends to drop away. But so far, at least, you'd still conclude that the inflation story globally remains fairly benign. Just in terms of so one of the possible drivers of inflation going forward could be a pickup in wages growth. You are starting to see, I'll talk a lot about this in a minute, but just from a broad perspective here, you're seeing that wages growth, again, across the major economies has lifted, though it's still at pretty low levels. So even in Europe there, it's ticked up, but still well below 2%. Interestingly, part-time wages for part-time workers in Japan has picked up quite strongly. So that's been one of the safety valves for the Japanese economy. And then, of course, the US number there just ticked up in the past month. Now, one of the things constraining wages has been quite weak productivity growth, that, as you can see in that chart there. And again, that could be one of the drivers of business investment, is that, businesses are now responding, trying to lift productivity growth, because, it's been pretty weak at the moment. There's a lot of service sector jobs, but not a lot of productivity there. In terms of global market trends, just on the next chart to summarise, these are the major developments over the past year or so. Obviously, we've had the ongoing equity bull market, the S&P 500, had a weak US dollar. So the surprise last year has been that the US dollar weakened, didn't strengthen. And again, that was because the upgrades to global growth last year were not in the United States. They're actually in Europe and Japan, and to a degree emerging markets. The US was strong, was good, but no better than expected, and so the surprises were elsewhere. If you look more recently, I guess obviously the big development has been the breakout in bond yields. So US 10-year bond yields have been actually rising for a while. They actually stabilised through much of last year, but late last year and certainly early this year start to push up again. So now, US 10-year bond yields approaching 3%. That has led to a correction in the S&P 500, as you can see on that chart. And the debate now is, how far will interest rates go up? What kind of impact that will have on the market? Meanwhile, commodity prices have also been generally solid, helped by the weakness of the US dollar, but also, good global growth leading to pickups in demand. Now, so let's get into it in terms of that US wages number. So those that follow the markets reasonably closely may well recall that a couple of weeks ago we had a payrolls result come out in the US. That's their monthly employment result. And the wages number took most interest. It actually ticked up from around about 2.7% to 2.9%. So it was higher than the market expected, as you can see on that chart there, that sort of zigzag effect. And it led to the first downturn in the market. And ever since, we had a pullback at its lows of around about 10% in the S&P 500. So labour market in the US is tight. The unemployment rate is at 4.1%. So the issue is wages growth now starting to pick up? 2 points. A, yes, it has lifted. So if you look in the early, coming out of the GFC, it was running at quite a lower pace, only around 1%. It's ground up to around 2%, just over 2%. But I think that the last number was a bit of a rogue number. If you actually look at the annual growth there, it is quite volatile and quite choppy, and it actually dropped down to only 2.2% back in October, when there were big cyclone effects in the US, and basically a lot of lower income workers that usually would be hired basically were asked, don't bother turning up for work, and the result was that's what helped push up wages, but the result before that, and then as they came back to work, it led to a big drop down in the wages number. So just to correct that, in the September it spiked up, then it spiked down as they were basically re-employed, and now it's spiked up again. It's been quite a volatile pattern. But one of the things generating that January result was A, that ongoing weather effect, B, increases in minimum wages, a one-off minimum wage increases in a number of states, and some seasonal reanalysis, which affected the earlier numbers. But I actually think that 2.9 will actually tick down to probably around 2.7 next month, and will be greeted with a bit of relief from the markets. Having said that, I mean, the trend is for gradual increases in US wage inflation. I've just got that number from a longer run historical perspective. As you can see there, the wage measure that we look at now has only been going back for a decade or so, but there's a longer run measure that I've got in that chart, which basically shows that historically when wages get up to around 3.75% or so, with the labour market, unemployment rate dipping around 4%, that's when inflation starts to become an issue. Central banks start to raise interest rates aggressively, and you get the next downturn in the markets and the economy. So we're not there yet. I mean, again, inflation is at worst wage inflation at worst is 2.9%. Should it go up this year to 3.5%, 3.75%, then yes, you can clearly say we've got a wages problem, and the next bear market probably will be upon us. But we're not there yet, and the anecdote suggests that overall wages growth is still likely to remain fairly contained, I think, in the US would be my core call. But again, that is going to be a key indicator to watch going forward over the next few months. So what about the market correction that did lead to that the wages number? So the other point to note is if you look at the next chart, so this is a chart of the S&P 500 index, and that funny line at the bottom is called the relative strength index. And what that basically shows you is when the markets tend to get overbought and oversold. So if you have a number of days of very strong price performance, or even a number of weeks and months, that RSI indicator tends to push up. And usually when it gets around 70, it means that the markets are overbought and due for a correction. Well, as it turned out, in late January, it hit 90. So it was basically off the charts in terms of being overbought. And, readers of our, my weekly Bassanese bites, and even in our monthly blogs, have been saying the market was due for a correction because it's been overbought for a while. And as it turned out, we got that correction, pretty quickly following that payroll result. So basically, the market technically was primed for a correction, and then the payrolls result came in and provided that excuse for that correction. But fundamentally, let's go forward. I mean, the good news is that, so what is the outlook for markets? First, again, this is a chart of earnings expectations for the global index, the global MSCI index. And basically, those squiggly lines are analyst expectations for earnings in each of those financial years on a rolling monthly basis. As you can see, that the market is expecting earnings growth to lift in 2019 and 2018. And if those expectations hold up, then that line, that dark line there, which is forward earnings, will basically continue to gravitate upwards. And in fact, between now and end of 2019, if expectations hold up, you're going to get something like 20% growth in forward earnings, which is the earnings measure that underpins the market. And not only that, if you look at that chart closely, there have been upgrades to earnings expectations in the last few months. And the Trump tax cuts, particularly in the US, are adding to the upgrades that we're likely to see over the next few months. So bottom line, the earnings outlook at the moment globally, including the US, including Japan, including Europe, is good. And that will underpin equity markets. The challenge now is what happens with there's two things that drive the markets. It's the E and then it's the PE ratio. And as you can see in the next chart, this is, I guess, the bigger concern for markets is, are markets overvalued? So the longer run average of that PE ratio, and now I'm focusing on the S&P 500 because this is where most, concern is. The longer run average has been around about, 14 or so. It's actually pushed up to around 18 at the end of January. At the bottom of the correction last week, the PE ratio dropped to 16.7. The market has since rebounded somewhat and it's back up to 17.5. So it's still, above average. And the question is, will it need to come down somewhat? Now, one of the things that have been driving it up has been interest rates have been falling. And so if you look at this very long run chart of US 10-year bond yields, been in this multi-decade trend decline. But if you actually look at it, yields have started to tick up. So the bottom for US 10-year bond yields, they actually hit 1.45% in July 2016. So they have been rising already for a year and a half. And so today they're around about 2.9%. So we've gone from 1.45 to 2.9 and the markets are still lifted. Now, how is that possible? Well, if you actually look at the next chart, and that's the earnings, basically it's the equity premium of the market. So what that is the PE ratio, inverted, gives you the earnings yield, and you take away bond yields and you get that premium. And as you can see, that's actually been falling from pretty high levels. So in that period from mid-2016 to now, the risk premium has gone from 4.4 to 2.9. And so that's why the PE ratio has actually managed to hold up, even though interest rates have lifted. So the question is, can that fall further? Potentially bond yields rise and the PE ratio doesn't fall, and that risk premium can decline somewhat more. So the great uncertainty for markets is, what is a fair value equity risk premium? And if you look at it over a 50-year time frame, there's no natural, average level. Like the long run average over that period is 2.5%. Since the GFC, it's averaged, closer to 4.5%. In the China boom, it was around about 2%, so it's jumped all over the place. My tendency will be it's going to decline somewhat more, which will partly limit the degree to which the PE ratio needs to sell off over the coming years as bond yields rise. But nonetheless, the PE ratio will be a drag on equity market performance over the coming year. It will come off a little bit. Now, there's some other ways to measure the market. I'll just show you, again, one of the points of what I'm about to talk about is when you read stories saying the market is overvalued, it's due for a correction, you've got to take these things with a grain of salt because there's been a lot of structural changes going on so that the typical valuation indicators that we've looked at aren't giving the signals that they used to give. And we're in a kind of a state of flux. So I think you need to not necessarily be convinced that the markets are grossly overvalued and due to collapse. So one, for example, here is the Buffett indicator. So this is US market capitalization as a percent of GDP. As you can see, it's at a quite high level, almost at the highs that we got during the dot-com bubble. And prior to the last few decades, it used to average at quite a lower level. And Buffett used to use this as a rule to basically say, well, my 10-year view on the markets would be whatever GDP growth is, plus a regression to the mean, a movement of this ratio back to its long-run average. Whereas the problem is that up until, for the last few decades, the average has been quite a bit higher than what it has been historically. So, what is the average? Is the average now higher than what we saw in the 50s, 60s or not? And Warren Buffett himself has actually sort of downplayed this indicator of late, and that is acknowledged that it's held up higher for longer than expected. Now, one of the reasons it's held up, if you just go to the next slide, is that the profit margins in the US have structurally moved higher. So this is the profit margin. So profits as a percent of GDP. And again, like around the world, everyone's bemoaning low wages growth, the lower share of income going toward workers and going toward profits, and that's reflected in that chart. And that's why the market cap to GDP ratio has moved higher because of that lift in profits. So the question is, is it going to stay at this higher average, or is it going to eventually regress back to the mean? And that's where the debate is at the moment. Now, there's another indicator, and I won't dwell on this too much, but again, another one you may hear is the Shiller PE ratio. And so this is basically the US market as a ratio to the 10-year moving average of earnings. And at the moment, it's running at around about 30, which is, again, high. Not as high as we got during the dot-com bubble, but nonetheless above average. And people are saying, well, based on the Shiller PE, and what I've also done there is looked at the subsequent 10-year real price return of the market, depending on where the Shiller PE ratio has been. So as you can see, at previous peaks in the market, 1925, 1960, and 2000, they were associated with relatively weak performance of the share market over the subsequent 10-year period. And so that would suggest to you, yes, the next 10 years is going to be a weak period of growth. But if you look at it in another way, and what I've done again, you can't ignore what's happened to interest rates. And so this is the Shiller risk premium, if you like. So again, it's the Shiller PE ratio inverted, less, so that gives you an earnings yield, less the bond yield, and you can see that's still positive, whereas in the previous times where the PE ratio was quite high, that risk premium was close to zero, if not negative. So at the moment, it's still, it's still tighter than the long run average, but nonetheless, it's much healthier than what we saw during the previous times that the Shiller PE ratio was high. So I just again, it goes back to, profit ratio is structurally higher than it's been historically, and interest rates are structurally lower than they've been historically. So that is knocking around valuation indicators, and it's not, absolutely clear from these long-run indicators, whether the market's very cheap or very expensive. Okay, we've all got to make a call. We've all got to place our money somewhere. So what is my view? And so this is how I've kind of thinking about the market, is that I think that bond yields are going to go higher. I've been targeting a 3% bond yield in the US, but we've actually got there. We're almost there already. So let's say it goes to 3.25%. Let's say the risk premium drops down a little bit more, from about 3.1 to 3. It's consistent with the PE ratio coming off to around about 16. Now, when I did this, the PE ratio was at 16.7. So going from around about 17.5 down to 16, it's still going to be a drag on the markets, something like a 3 to 5% drag, but offsetting that could be 10 to 12% growth in earnings. So that's why I still see we're at that stage of the cycle basically where, yes, interest rates are rising, but earnings are rising also, and the lift in interest rates is still going to be that relatively moderate. Plus the market is not super expensive given where interest rates are. There's some scope for the PE ratio not to fall in a heap, basically. So that's why I'm still bullish. That's why I still think, yes, this is just a correction, and markets will regain, because I think interest rate lift won't be too bad. I think the inflation scare we've seen in the US is a little bit basically overrated. And going forward, markets should be somewhat, happier that you're going to see continued good growth and still relatively moderate inflation. So what about the Australian outlook? So in terms of the economy, here's some key indicators. National business. So basically, these are the 4 key indicators if you had to pick 4 to track on a monthly basis. The National Australia Bank Business Conditions Index. We actually got this out just yesterday, and it showed another very encouraging lift in business conditions. So as you can see from that chart, is at quite comfortably high levels. So businesses are quite confident. The unemployment rate has gradually continued to trend lower. So it's now around about 5.5%. And, the RBA only a week or so ago predicted it will drop down to around 5.25%. That's probably a reasonable view given what we're seeing in terms of employment growth. So things are going along well there. One of the challenges is building approvals. Again, it's a very choppy series, but nonetheless the trend is down. But the underlying trend there is still quite gradual. But the home building boom that we've had is coming off the boil, which will be one of the challenges for the market, for the economy. And the other indicator is consumer confidence. As you can see, it had been in pessimistic territory, but more recently it's actually ticked up a bit. So at least based on this survey, consumers are starting to feel a bit more upbeat. And I guess a couple of reasons there is the ongoing strength of the labour market households, if you look at the survey and the details, they're feeling a lot more confident in terms of their employment situation. Possibly means they could start asking for higher wages. Not seeing a lot of evidence of that yet, but nonetheless, it's an encouraging indicator, let's say. If we go through you actually look at the economy, there are quite a few drivers helping support the economy. So we've got exports lifting, we've got natural gas exports coming out of those major facilities in WA and Queensland, iron ore exports picking up, education, foreign students are coming back into the country. You've got infrastructure projects going on in the major states, road and rail projects. You've got office construction starting to lift. So again, business surveys suggest non-mining investment is starting to lift, and that is being seen in a lift in office construction. And meanwhile, on the jobs front, we've got, if you actually look at where the jobs are coming from, a lot of it is in healthcare, in social assistance, and so hospitals are still seeing strong activity, strong employment, and the NDIS that's being rolled out is taking up a lot of jobs as well. So a lot of positives. Just go to the next slide, where we'll see, just to round out that discussion. So yeah, non-mining. So in terms of business investment, mining investment is bottoming out, and non-mining investment from the surveys is starting to lift. And again, for those in the mining states of WA, Queensland, to some extent Northern Territory, the good news is that conditions there are bottoming out and starting to lift. So we are seeing a convergence in economic activity between the states, in the sense that the non-mining states are starting to recover somewhat following the downturn in commodity prices and mining investment. So what is the bad news, or what's holding us back in terms of the economy and share market performance? Well, it's consumer spending. So consumer spending is about 50% of GDP. As you can see there, it's running at around about 2.5%, which again, if 50% of your economy is running at 2.5%, it's going to constrain the ability for the overall economy to grow much beyond that. And it's actually worse than that, because incomes growth has been weaker than consumer spending, and what consumers have been doing, what households have been doing, if you look at that bottom panel, is that the savings rate has been declining. So we've actually been spending more than we're earning and running down our savings. The retail sales numbers are quite interesting. They come out on a monthly basis, but if you actually look at we also get volumes on a quarterly basis. They've been very choppy. So just to give you an example of the choppiness and trying to get a handle on retail spending, in the March quarter, real retail volumes rose by 0.1%, basically flat. Then they surged by 1.4% in June, flat again in September, 0.1%, and then rebounded 0.9% in December. So very choppy, and it brings to mind the Katy Perry song "Hot and Cold." It's just when you think things are heating up, they go all cold again, and vice versa. So it's been frustrating to get a handle on consumer spending, but overall it's been choppy. And pretty moderate is the best to describe that. Now, and one of the things holding back consumers is the wages picture. So again, this is a chart from the Reserve Bank in their last quarterly survey. Now, so the wage price index is the key single indicator for the economy, and that's running at around about 2%. So not great. We'd like to see it higher, but in fact, some other measures are even weaker. So average earnings per hour are running at an annual basis of only 1%, as you can look in that chart. And I guess more concerning, or another concern, is that the rate of wage gains in new enterprise bargaining agreements. So these are, the workplace agreements. If you look at that, the line in the lower panel there is actually ticked down. Was running at around 3%. The last few quarters, it's been running closer to 2%. So that is a lead indicator of where wages overall may go. So if the enterprise bargaining agreements are only giving you 2%, it's hard to see overall wages in the economy lifting much beyond that. So again, that is something the Reserve Bank noted in its recent quarterly statement, and it's why it suggests that despite the strength of the labour market, despite the unemployment rate ticking down, it's unlikely we'll see a big turnaround in wages anytime soon, which in turn will constrain the growth of consumer spending. The other thing that may constrain consumer spending is the property market. So here's just a chart of Sydney. I guess, the big development over the past 6 months or so has been that the Sydney market, the mighty Sydney property market, has finally turned. Sales conditions have dropped off. And one of the reasons there is that, affordability has basically hit its max. So without going, basically, that dashed line there is mortgage affordability. So it's the percent of income that a household on average earnings would need to devote to a mortgage to pay for the median priced home in Sydney. And you can see it's over 40% now. At those levels historically, it tends to struggle to go much higher, and it's usually when you see a turn in the property market. So sure enough, that's what we're starting to see in Sydney. And so, is the market going to crash? No. But will it decline? Yes. It's off, based on core logic prices, the market is off 3% from its peak. And it wouldn't surprise me at all to see it off 10, possibly 12% over the next 1 to 2 years. And don't forget, this is, the RBA hasn't raised rates yet, but it will eventually, which will be another sort of headwind for the market to digest. So what about the key market indicators here? So look, as you can see, bond yields have lifted of late, but not to the same degree we've seen internationally. They've still been in that broad range. And in fact, the 10-year bond yield vis-a-vis the US, the gap there has narrowed quite a bit. So now the US bond yields are now starting to push above Australian bond yields, which has been an historical, haven't seen that in 20 odd years. Our market had a correction along with the US market, as you can see from the S&P, though that was after a pretty strong run late last year. Aussie dollar's come off. It was threatening to hit 80 odd cents. It's come back. It's still, I guess, higher than the Reserve Bank would like. It's around that 78, 79 cents. My view, it will eventually correct lower. I still think my year-end target is 74 cents on the back of the Fed continuing to raise interest rates, commodity prices softening. Again, a key driver there is iron ore, as you can see in that chart there. Iron ore has lifted since late last year, and I think it's going to basically roll over again and start to soften. If you look at some of the indicators coming out of China, they've tightened up on industrial production, trying to close down unprofitable steel mills, and I think that's got to eventually weigh on iron ore prices as well. Looking at the relative performance of our market versus international, this is my very long run chart to get those broad patterns over time. And basically, again, since the GFC, we've tended to underperform. It's not just the resources sector, though. What's interesting of late in the past year have been the banks. And as we all know, banks are a big part of our market, but they've basically gone nowhere price-wise, whereas global banks are up something like 20-odd% in the past year. So it's been a big driver of the relative underperformance of our share market vis-a-vis global markets. And, the trend there, I think it's still, if you look at the earnings outlook, you're looking at something like 5% growth for forward earnings over the coming 12 months based on earnings expectations for Australia versus 10 to 12% globally. So earnings, at least, is not going to be a source of outperformance. On a relative valuation basis, it's hard to say we're especially cheap either. So, at best, our market's going to match global performance, but probably continue to underperform would be my view. And in fact, as you'll see, most of my, investment ideas, my growth ideas, are in international markets still. And that is, in fact, what we'll get onto right now. So just to conclude the presentation, some of my favourite investment ideas. Look, regular listeners in on these webinars, will be familiar with some of these ideas. I mean, a good idea is one that should last for a while, and these ones have been doing very well, and I still think they will continue to do well. The backdrop certainly supports them. So firstly is the NASDAQ. Even overnight, the NASDAQ, a lot of those big FANG stocks roared back. There's certainly a lot of underlying demand for those products. Just the point there, the price performance has been quite strong. It's been underpinned by continued solid earnings growth. PE ratio around 20 is still not grossly overvalued, and I still see it as the NASDAQ likely to outperform in global markets. And so we do have an ETF that tracks the NASDAQ, is the NDQ, and it's also unhedged, so you're also getting US dollar exposure vis-a-vis the Aussie, which around about 78, 79 cents is probably not a bad entry point. The other one is Japan. Again, sorry, just to put some numbers on that. So the our NASDAQ fund is up 28% over the past year. So, pretty good performance. But again, a lot of that has been driven by earnings growth, not necessarily just a PE expansion. The other one is Japan. So this is a chart of the relative performance of our Japanese ETF vis-a-vis global markets. Look, it's tracked sideways over the past year, but broadly, but nonetheless, if you look carefully, it has, since late last year, it has again tended to underperform. It's not been helped by the fact that the US dollar has been soft against the euro and to some degree against the yen. The Japanese market does particularly well when the yen is weak, but even with the yen sort of not weakening a lot, it's still been putting in good performance. That's because the Japanese economy has been doing well, and corporate earnings in Japan has also been quite solid. So again, to put some numbers on it, the HJPN is up 23% in the 12 months to end in January. And, again, I still see that as a good source of outperformance. I think the yen is going to soften up again versus the US dollar, which will be another tailwind for that market. Because, again, at the end of the day, the Fed will be raising rates. The Bank of Japan won't be touching interest rates. It's still targeting a zero bond yield, a 0% 10-year bond yield, and not looking to tighten policy there for at least a year or so. The other one is global banks. And again, we have an ETF that tracks global banks. BNKS is the ticker. And as you can see there, it's tracked this, but relative performance is a key driver of that is bond yields. And so when bond yields sold off in late 2016, banks went on a tear. They underperformed during the rally over 2015. Kind of tracked sideways broadly last year, but now with the recent lift in bond yields, global banks are starting to outperform again. And again, and if you believe that bond yields have got further to rise, then global banks are in the box seat in terms of being able to outperform global markets. So again, our global banks ETF, 24% return over the past year, and you may be you're not going to get 20% growth, but I still think whatever the global markets do, banks are going to do better. What about Australia? Now, the ones I just highlight our income. For those that I guess want less volatility, you're looking for products that have less volatility, but have decent income. I just highlight the fact that we do have a range of products, an expanding range of products in this area. So if you want, at call, if you want cash, basically the safety of cash, we have the AAA ETF, which still gives you a yield of at least 50 basis points over the RBA cash rate, competitive with a lot of bank term deposits. We also have a floating rate bond ETF, coupon, which again, it gives you that liquidity. You can buy it and sell it with a T+2 liquidity, but the yield on that is very comparable to what you'd get on term deposits. And an even juicier yield is our bank hybrids fund, HBRD. So allowing for franking credits, the gross income yield on that is just over 5%. And again, if you look at the most recent sell-off in the markets, the hybrid market held up pretty well. So hybrids, they're going to be a bit more volatile than your typical bond, but nonetheless a lot less volatile generally than bank shares in particular. So another option along the risk-return spectrum is the bank hybrid. And that fund actually since launched, it's an active fund. I won't say a lot about it. If you want some more information, go to our website and have a look. But it actively manages exposure to hybrids. And so if the hybrid market gets too hot, there is a mandate to reduce exposure to hybrids. And that fund has actually outperformed its benchmark since it's been launched. In terms of the Australian market, I just highlight our flagship fund, the RAFI 200, which again has delivered quite consistent outperformance generally over time versus the ASX 200. So if you are just looking for a core index exposure to the market, why go for the ASX 200 when you can go for the RAFI 200 and generate something like 2% outperformance over time, just because it avoids weighting by market price and avoids basically overweighting overvalued stocks. And it has that nice outperformance. Again, if you want more information on that in the interest of time, definitely go to our website. We've got a lot of information there in terms of why that tends to outperform over time the ASX 200. And another one to think about, when you think about the challenges of our market, the resources, I mean, if the resource prices come off again, I think the good performance we've seen in resources is likely to unwind. But most importantly, the banking sector has been a bit of a dead weight on our market. But if you actually go outside the mega caps of our market, and you can do that through, for example, the X20 fund that we have, so that is the ASX 200, stripping out the top 20 funds, you can see that that's actually been quite a solid performer over the last few years. So again, it's another way of getting broad, diverse access to the Australian market, but reducing your exposure to those mega cap companies that have been holding back our market. So the X20, for example, over the past 12 months, it was up 19.8%, versus the ASX was up 12.8%. So look, that's a quick snapshot of some of the, some ideas out there. Go global for growth, go Australia for income, I think is still the theme. And just to summarise, look, good growth going on globally. We've had a bit of an inflation scare. I think the markets have overreacted to that. I think things will settle down. Bond yields will be rising, but gradually and not by enough to kill the what I think is an ongoing uptrend in global equities. Look, I'll leave it there, and happy to take some questions.
Thank you, Dave. And it's great to, have some sense and to see the charts and data behind the recent corrections, and a lot of positive news as well for our domestic economy. And you've also made some bold predictions, so we'll be coming back to that at the end of the year, especially the 74 cents on the US dollar and those Sydney market declines. I'm sure not all of us hope they come through. So we've just got some questions here, and there's quite a few questions, but if you have any more, please send them through. And something that you haven't talked so much about is about China. Mm-hmm. And there is, I guess, some criticism of their handling of inflation and debt and how that impacts the rest of the global economy.
Yeah, look, I haven't said a lot about China because it's still chugging along reasonably well. I mean, there's a lot of concern about debt that's constantly raised. Look, my thinking on China with regard to debt is basically what you're seeing is, state-owned enterprises that don't make a lot of money. They do a lot of unprofitable, steel production, property development, and they basically rely on bank funding to sustain themselves, which is, so basically that's what the source of the debt is. But I mean, if everything goes pear-shaped in China, it'll be the government that ends up wearing that debt. So the way to think about it is it's basically government subsidies intermediated through the banking sector. Now, will that blow up anytime soon? No, because even at today's levels, I think it's all domestic debt. And the Chinese government could wear it if it needed to be. So again, it's not an ideal scenario, but it's not something that is likely to blow up anytime soon in terms of the global economy. You think about debt run-ups in other countries in the past. We've had a lot of private corporate debt where they've borrowed internationally, and they've borrowed because the currency has been pegged, and interest rates internationally have been lower than they were in the domestic market. So companies went and borrowed at lower rates internationally, thinking the currency would hold up. Then that weight of money basically put pressure on the currency. I'm thinking about the Asia crisis here, and then things blew up. But the situation in China is very different from what we saw during the Asia financial crisis, for example.
Thank you. A question here just in relation to while you've recommended the global banks, and you've spoken about that in one of your ideas, your opinion on the local Australian banks?
Look, the way to think about our banks is like utilities, essentially. I think they don't have a lot of growth opportunity at the moment. I mean, they had a good run because, credit as a percent of GDP had a multi-decade trend upwards, but now it's trending sideways. The overall property sector is turning. And you've got basically, part of the reason they've had good profits over the last few years is that bad debt. They've been able to reduce their bad debt exposures. But again, going forward, those write-offs, the bad debt sort of write-downs are now at pretty low levels, and that's not going to be a source of profit growth going forward. But nonetheless, look, they have a dominant position in our financial system. They basically price setters, and they earn a comfortable interest margin, so they'll be still generating good dividends, good income. I don't think the Royal Commission at the end of the day is really going to seriously threaten their strong position in the market. So yeah, as a source of income, they're still a good source of income, albeit you've got to take the equity volatility associated with that. If you want to diversify your exposure in the financial sector, I just do point out we do have an ETF that covers the financial sector, QFN. So if you like the yield story and you want a simple, diversified exposure to the financial sector without putting, juggling, multiple bank holdings, then QFN is something to think about. And the other one, of course, is hybrids. So it's the bank hybrid, where it gives you maybe not as higher income than the dividends that banks offer, but certainly less capital volatility over time.
And I guess just to follow up on that point, there is a question, Dave, about how why would someone consider hybrids, and what's their benefit?
Look, yeah, the benefit is basically it's a spectrum. If you think about the different investments offer different levels of income, different levels of capital volatility. So at the one end, bank shares, the income, the grossed up dividend yield from bank shares is still higher than from hybrids. But nonetheless, you do have to wear the capital volatility associated with bank shares. So the income from hybrids is not as high. It's still definitely higher than what you get from cash and the fixed rate typical government bonds. But you're getting less capital volatility. So it's that trade-off. Now, the other special unique features of our fund thing is you can go and buy hybrids yourself, but getting in and out of that market it's not a very liquid market. There's a lot of opportunities for a skilled professional fund manager to generate alpha in that market, because a lot of the trading that goes on is from average retail investors who maybe are not particularly savvy in knowing what are the best value hybrids out there. So that's why we offer a fund to actually provide those advantages.
Thanks, Dave. And just obviously just more generally about ETFs, there's a question here about asking for your comment on the recent market criticism of ETFs and that they are the cause of some of the most recent market volatility.
Yeah, look, a good question. Look, a couple of points. Firstly, you may have read a story about an exchange traded note in the US that did blow up, and this was basically a fund that basically bet on volatility in the US market staying quite low. And so if the so-called VIX index, if it stayed quite low, basically that fund would generate money because it was selling. It was, without getting too technical, it was basically selling options against the VIX and you're collecting income on those options provided that, the VIX stayed low. But obviously when it blew up, it was a very illiquid market. And as they tried to cover their short positions in that VIX market, they found the bids ran away and they basically, the fund ended up blowing up. So that's an example of a fund where if the underlying securities are quite illiquid, you can have problems. And so that is nothing to do with ETFs per se. It's just the nature of the underlying investment strategy of that particular fund. Most of the other more traditional ETFs that, were investing in underlying shares and bonds in the US and in Australia performed very well through the sell-off. So, they basically delivered what they said they would do. Now, another question, though, is, are ETFs causing, investors to pile into the market and, pushing the market higher because of ETFs? And again, my argument for this has long been no, it's not, because what you're basically seeing is ETFs are a way of investing in the equity market. And so what you're seeing is people are investing through ETFs and not through, say, unlisted managed funds or even directly investing in shares themselves. So I don't think we're seeing a net increase in demand for shares per se just because of ETFs, but ETFs are basically a new and popular way of investing in the market, and for good reason, for the low cost diversification access ones that they provide.
Thank you. Just a question here about ethical investments. So, what do you think? What your opinion, obviously, and then the prospects for any other ethical investments?
Yeah, good. Thank you for that question, because we do have some ethical funds out. Look, I'm all in favour of ethical investing. It makes good sense. From a moral point of view, I guess if you are concerned about the use of fossil fuels, your use of worker exploitation, a whole bunch of different issues, it's nice to invest in a fund that screens out a lot of those companies. But it also makes a good business case, because effectively at the moment, a lot of particularly our ethical funds, effectively have a green energy bias, which in the markets is performing quite well. So definitely, it makes sense. And we have a global ethical fund that we have launched, and we also have more recently an Australian ethical fund. And again, if you want more information on those, definitely go to our website and have a good read up about them. But the point I would make about our funds is that there are some funds that claim to be ethical, but they have a very narrow screen, and so they might include the banks, for example, even though the banks, lend to fossil fuel producers. What we've done is we've tried to come up with the most comprehensive, widest set of screens possible to appeal to the broadest set of ethical investors out there. And so, I definitely commend having a look at our funds if you are interested in that type of product.
Thanks, Dave. We'll just have one more question, and there are quite a few that sort of follow a similar theme. And you did mention that the US is likely to raise rates. And so how is the market going to react to that? And what are some of the key indicators that we should be looking at that may follow that may cause another correction or the start of something?
Sure. Okay, so just in terms of the US, so yes, the Federal Reserve at the moment is on track to raise rates 3 times this year. I think the market is more or less fully adjusted for that, and that's a central case expectation at the moment. But they did raise rates 3 times last year as well, so this is nothing new. The markets are learning to adjust to this. Bond yields are rising as a result. So again, my year-end target for 10-year bond yields had been 3%. I'd say it's now 3.25%, simply because we're already getting there quite fast. But 3.25%, I don't think would still derail the equity market. It'll take some pressure, take the edge off the PE ratio, but earnings will more than offset that. Now, so what are the key indicators to continue to look at? As I said, wages. The market is super hot now on the fear or the risk that a tightness of the US labour market is going to lead to a breakout in wages growth. So that is, I guess, the key single greatest risk out there. And so come that next payroll result next month, the markets will be white hot on, what that average hourly earnings number does. And so, that is, I guess, the biggest risk. And like the CPI was out last night, consumer prices, it was a little bit higher than expected, but the market initially sold off but then rallied back. And basically because bond yields sold off a little bit but not a lot. And when you think about it, that's not where we're going to see inflation initially show up. I think consumer prices are going to remain fairly benign. The risk is, that it's going to be the wages, which eventually does flow through to the CPI if they do pick up. So at the moment, the thing to watch is the US wages number.
Thanks, Dave. I just want to take one more question, please, and it's a follow-up to your previous question about the ETFs being not to blame for the market volatility. And it's basically the risk involved in being able to sell out of an ETF quickly when the market gets volatile, because so many people are now invested in ETFs.
Question, of course, but index track investing in large cap stocks. So what you in offer spreads those a little the uncertainty, trying to hedge the funds should be able to investors want to sell and transactions with us, sell the required amount of shares in the market. So that is the transaction that would take place. But look, in the moments of panic, in any extreme market sell-off, I mean, you try to sell a small cap stock, a large cap stock, an unlisted managed fund. I mean, in any moment of panic, those things are going to trade a little bit differently than what they normally do. So in unusual circumstances, everything will trade a little bit unusually, but ETFs will be no more unusual than anything else, I would say, in the market. And I said, over the last few weeks, over the last week or so, most of the large cap, most of the, the big ETFs that invest in liquid underlying securities have performed pretty well, including our own funds.
Thank you. Thanks, Dave. And thank you, everyone, for joining us. We will conclude the webinar there, but I do encourage everyone to have a look at our website for further information about the funds and ideas that David has spoken about. We will send a recording of the webinar and some follow-up information, updated fact sheets with an email. If you are not already subscribed to David's Monday morning Bassanese Bites, David provides a really quick update on what's been happening in the last week and what's, the key happen. So if you're not subscribed to that, then please visit our website and check it out. But thank you for joining us, and we do look forward to seeing you at our next webinar. So thank you very much.
Thanks a lot, everybody.